Do you know that in a little over a year, the tax laws likely are going to change, which could mean that you'll need to pay more in taxes? Do you know how to best prepare for the upcoming tax changes so that you'll pay as little as possible? If not, today's video explains what you need to know about the likely sunsetting of the 2017 Tax Cuts and Jobs Act and its potential impact on you so you can keep as much of your hard-earned money as possible. Ready? Let's start. I said that the coming tax changes are due to the likely sunsetting of the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act was passed by Congress in late 2017 and became effective in 2018. This act made many changes to the tax code, especially to individual income taxes and to estate taxes. Many of these changes, however, will revert back to the previous 2017 rules on January 1st, 2026, unless new tax legislation is passed by Congress. So what are the expected key changes for 2026? First, most federal income tax brackets will be going up. Let's go to 2 slides to take a look at this. So you can see in this slide, upcoming changes single, that most federal tax brackets will be going up. You see here you've got the current tax rates on the left, the current brackets, then the new brackets that are expected to come, and the expected 2026 tax rates. In general, you can see that for the same level of income, you'll often be in a higher tax rate. So for example, currently, if you're making $150,000, your marginal rate would be 24%. But that same amount of income, $150,000, in the new tax rate structure would make you at 28%. Let's go to the next slide. The next slide basically says the same thing. Upcoming changes jointly, you're going to see the current rates, the current brackets, the new brackets, and the new rates. And again, the same thing happens. Generally, for the same amount of income, you will often find yourself in a higher tax rate. Regarding capital gains and qualified dividend income, the Tax Cuts and Jobs Act separated the tax brackets for these from the tax brackets for ordinary income. In 2026, the tax rates for capital gains, while not changing, will be reconnected to a person's tax bracket for ordinary income. This could mean that some people will have to pay higher taxes on capital gains and qualified dividends. Next, the standard deduction will roughly be cut in half, from $14,600 to $8,300 for single filers, and from $29,200 to $16,600 for people married filing jointly. This could mean that more people will be itemizing their deductions in 2026 compared to now. Also, some itemized deduction rules will be changing back to what they were in 2017. For example, currently there is a cap of $10,000 on the amount of state and local taxes, or SALT taxes, that you can deduct from your taxes. The SALT cap will disappear, or expected to disappear in 2026. So people in the higher tax states like New York, New Jersey, Connecticut, Illinois, California, and so on, will be able to itemize bigger tax deductions. Also, the mortgage interest deduction will become more favorable, going from the amount you can deduct from an amount of $750,000 of mortgage value up to $1 million of mortgage value. Some miscellaneous itemized deductions, subject to a 2% of adjusted gross income or AGI threshold, will also be coming back. Since more people are likely to itemize deductions in 2026, the number of people having to pay the alternative minimum tax, or AMT, is also likely to rise. The AMT typically now only applies to ultra-high earners, but from 2026 on, people earning $200,000 to $400,000 per year could also be affected. Now, while some deductions are expected to come back, other items will decrease or go away entirely. For example, the child tax credit is expected to drop from $2,000 per person to $1,000. And the qualified business income, or QBI deduction, where owners of pass-through businesses could potentially deduct up to 20% of their qualified business income For example, S corporations, sole proprietorships, and LLCs. This QBI deduction will go away entirely. Due to this, if you own a business, definitely ask your accountant if you can take advantage of the QBI deduction in 2024 and 2025 before it heads off into the sunset. Lastly, in 2026, the federal lifetime gift and estate tax exclusion amount, well, that's a mouthful, will decrease from currently about $13.6 million per person to about half of that, or roughly $7 million per person. Okay, so now you know some of the key changes that will happen in January 2026 if Congress doesn't pass new legislation to extend the Tax Cuts and Jobs Act. So the big question is, what are some of the strategies to consider doing now to help you pay as little in taxes as possible if this happens? Of course, all of these strategies should be carefully evaluated by your accountant and your financial advisor before you take any action, as each person's situation is very different. This video is for educational purposes and not tax advice. But here are some items to seriously consider. 1, accelerating income. If you expect to be in a higher marginal tax bracket in 2026, it could make sense to move income from 2026 into 2025 or 2024. Some examples of this could be earned income if you have your own business, or if you have some discretion over when your income is paid, that would be good too. Partial Roth conversions also. More about this later in the video. Another way to do things potentially is accelerating capital gains. If you expect your capital gains tax rate to be higher in 2026, it might make sense to harvest long-term capital gains in 2024 or potentially 2025 to take advantage of potentially lower capital gains rates. Included in this category would be potentially exercising stock options or selling some of a concentrated stock position to reduce your risk via diversification. Also, if you're thinking of selling some real estate or a business, selling before 2026 may make good financial sense. Another strategy, deferring deductions. If you will be in a higher marginal tax bracket and the standard deduction will be lower in 2026, it could make sense to defer some deductions into 2026 when they will be more financially valuable to you. For example, you could bunch up a couple of years' worth of charitable deductions. For example, let's say for the 2024, 2025, and 2026 years, and donate them all, that total amount in 2026, via a donor-advised fund. Let me know in the comments section if you would like me to create a video on tax-efficient charitable giving strategies. If you are paying estimated taxes, consider delaying your 2025 Q4 state tax payment until January of 2026. That way you can maximize your state and local tax deductions in 2026 when the SALT cap of $10,000 is lifted or will be raised. Another thing to do is think about potentially is deferring capital losses. If you will be in a higher capital gains tax bracket in 2026, any capital losses you can harvest to offset gains will be more valuable to take then rather than now, since they will help you reduce your taxes at the higher tax rate. Earlier I said to consider partial Roth conversions as an item that could financially benefit you. A Roth conversion is when you convert some of the assets in a traditional IRA of yours into a Roth IRA. You pay taxes when you make partial Roth conversions. For example, you pay taxes at ordinary income tax rates on any assets moved from a traditional IRA to a Roth IRA in the year the transfer happened. The benefits of partial Roth conversions are that once the assets have successfully transferred into the Roth IRA, their growth compounds tax-free, and any distributions that are taken out are tax-free if you take them after age 59 and a half, and as long as you have held the Roth IRA account in your own name for at least 5 years. And you also, as a bonus, don't have to take any distributions out of the Roth IRA at all if you don't want to. So if you expect your marginal tax rate again to be lower in 2024 and 2025 versus what it might be in 2026 and beyond, converting some amount into a Roth IRA and paying taxes at the current lower rate and avoiding paying taxes again later at the higher rate might really benefit you financially. One important thing to remember though when doing partial Roth conversions is that when paying the taxes on a partial Roth conversion, it is very, very important that you pay them from taxable assets that you have and not from the money that is coming out of the traditional IRA. You want all of the assets to move from the traditional IRA that you want to convert into the Roth IRA to get the maximum amount growing tax-free and compounding tax-free for you. Also, don't forget to ask your financial advisor and estate attorney if you should be doing anything in 2024 or 2025 to take advantage of the large federal lifetime gift and federal estate exemption before it likely gets halved in 2026. Your heirs will definitely thank you, and you don't want to wait until the second half of 2025 to start acting on this when likely all the good estate attorneys will be booked up by other people. Changing the subject, here are some good questions to ask your tax professional about the likely sunsetting of the 2017 Tax Cuts and Jobs Act to help get you started. For example, how will this law affect my tax situation? What proactive steps can we take now to limit my tax burden when the tax regulations sunset? Will there be any advantages afforded me when the rules change, expected in the beginning of 2026? Are there any new strategies we should consider in light of these tax changes? And lastly, how would state taxes be affected potentially by any of these strategies that we're considering? Now, I've given you a lot of, I hope, helpful information. If you would want to discuss any of these items or would like to discuss confidentially any other aspect of your personal financial planning or investment situation, please feel free to contact my good colleague, Jesse Freeling. His contact information is on the screen right now and also in the description of today's video. We at Altfest Personal Wealth Management have been helping busy, successful individuals like you achieve their key financial goals for over 40 years. We'd be very happy to listen to you, understand your goals and concerns, explain how we might be able to help you if we think we can, or give you our best thinking and point you in the right direction if we think that we would not be able to help you. Thanks for watching, and if you found this video helpful, please subscribe to the channel and make sure that you know the next time we release a new video, and also it helps us get this information to more people just like you who can benefit from it.